It's time for Wise Money with Korhorn Financial Group with financial advisors Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of Wise Money with Korhorn Financial Group, where every week we are helping you take your next wise step in your financial life. The blend of knowledge and action. Wise step in your financial life. My name is Mike Bernard. I am your host and one of the certified financial planners on the show. Thanks for being with us. With me here in the KFG studios, certified financial planners Kevin Korhorn and Josh Gregory.
Referred to as one of the great goals in life, paying for your children's education is something that we're going to get into today. And do you have a goal of paying for some of your children or your grandchildren's education? And if so, there are several practical, very important financial decisions that you need to make. So coming up this hour on Wise Money, we're going to tell you about what those critical choices are, and we're going to equip you to make a great decision.
Yes, we are talking about college today. It's also tax season, and we are still fielding lots of calls about what's going on with the new tax law changes, how it's going to impact you. So if you have a question, we want to hear from you. I'd invite you to reach out to us, and you can do so in a few different ways. First, you can call or text 574-222-2000. That's 574-222-2000. If you have any questions, want to reach out to us, need some help, you can reach us there. Also, wisemoneyradio.com is how you can find us online. You can submit questions there as well. Also, catch up on all the previous episodes and check out the blog and all that sort of stuff. Lastly, all over social media as well as YouTube, just search at Wise Money Radio. Every episode is on the YouTube channel. You can submit questions that way. And Facebook had some comments there recently as well. So reach out and like the page, subscribe to the YouTube channel, and all of that. Okay. We are more than halfway through our series where we're going through all the most important decisions that you have to make in all areas of your financial life. You know there are 6 areas to your financial life, and you can't deal with each area in isolation. Really, the magic comes is when you put them all together. You need a plan. We call that one plan of putting all of it together, and when you're tying it together, then you can make great decisions. What decisions do you ask? Well, that's what we've been covering on this series, and today we're talking about the most important decisions that you need to make in the area of college planning. The very first one that comes to mind for a lot of people is it's not necessarily a conscious decision, but it is. It is really. And that is, what role are you going to play, and what role do you want the child to play in paying for their education?
Yeah, I'm glad that you framed that as the very first decision, right? In fact, it needs to be right where you start as parents, deciding way down the road, how involved are we going to be with our kids' college planning? And I would argue that it needs to happen maybe even before you are parents, maybe even before you're married.
Whoa!
I actually, just this past fall, I was
maybe
working...
before you've met your spouse.
Let's not get carried away.
Okay.
Maybe while you're still in college yourself.
All right, sorry, come on.
No, we joke, but really that's when you're formulating your philosophy and your attitude on these things. And to understand your spouse's attitudes and beliefs on this, or your future spouse's attitudes, I think is wise. This past fall, I was doing some, I'll call it premarital financial counseling with one of my clients. He's been a client for a number of years, but he met his wife and wanted to bring her into the planning that we've been doing.
Love it.
And I was coaching them on some of the conversations they ought to be having around money before they get married. And a lot of it really was kind of attitudinal, philosophical type questions. What do you think about this? Mm-hmm. And this was actually one of the questions that I proposed that they ask each other. Do you think it's a parent's responsibility to help pay for their kids' education? And of course, everyone's attitude is at least partially flavored by your own experience.
Absolutely.
So yes, way back when you were in college. But the point, though, is you have to first decide, am I even going to help pay for college? It doesn't have to be just an assumed thing.
Right.
It's like a parent, a dad recently asked me, how old do your kids have to be before you get them a cell phone? And I thought, well, that presumes that I'm going to get them a cell phone. You know, maybe that's their responsibility. That's the first question, right? So in this, What's that?
I do have an answer for that one.
Do you?
And I feel bad for your kids.
As soon as they can type 60 words a minute.
Whoa.
I remember you setting that bar. That was pretty
And
cool.
2/3 have done it.
Yep.
And we're still waiting.
Yep. The point though is after you've decided that we're going to help with college funding in some way, then you start quantifying, well, how much?
Well, think about it. I mean, helping with college, it is an assumed thing, and it goes back to your roots of how did it work with your family and for you and your parents, what was their philosophy. But so many people out there just gloss over this decision and don't carve out the time to talk to their spouse about it, which, gosh, you've got to do that. But then you also need to talk to the child. I mean, think about it. College, if we're just weighing out the finances, are you going to pay for your kid's college or buy them their first house? And if I frame it like that, you're probably thinking, there's no way I'd buy my kid their first house. That's so expensive. I can't do that. Well, if you're just going to assume and not really have a proactive, intentional conversation about college, that's in effect what you're doing, really. Mm-hmm. And so, the first step is you've got to talk it out. Now, I don't know about you guys, but I wouldn't make any value judgments on, for some people, I have seen it work great. If they say, yep, we're going to cover all of it, okay? I've seen it work great when the parents say, we're not covering any of it, and everywhere in between. The point is, get on the same page and craft a plan and then loop the child in so they have ownership.
Early.
Loop
that child in early because we've talked to lots of folks, and this is easy. So this isn't a criticism. It's very easy to go through life, and there's no, if you have income for the prior year, you got to get your taxes done by April 15th. There's no date that says by this date you have to communicate with your children what you're doing with their education plan, what part you're going to play in that, the funding of that, and what kind of parameters and guidelines you might want to put on that. So I would encourage you, if you haven't done it and you've got children that may someday be college bound, I would start that conversation and not be afraid to get it wrong. Just get into it.
So what would be the ideal age? As someone who's sending kids out of the nest right now, when do you start having that conversation about what mom and dad's role will be and the kids? What would be ideal?
Well, I think 10. I think you need to start having the conversation about work and money. And, my kids were cleaning the office when they were 5. And so we talked about, okay, what are the 3 things you do with money, right? You give, you save, you spend. Okay. And what do you need to be saving money for someday? Well, someday you're going to want to go to college, and that's going to cost a lot of money. And mom and dad are going to help you with it, but you're going to contribute too. So make sure you're setting aside money for college. And so that is part of the messaging that your kids want to hear on an ongoing basis. And then when they're 10 and they cut the neighbor's lawn, or they're 12 and whatever they might be doing, that's when you say, hey, let's be thinking about this and moving in the right direction.
There's a couple ways that you could frame that discussion with your kids as well. If you've decided together with your spouse, yes, we're going to help in some way, there's 2 ways that you can define that help. One would be that you guys are going to commit to setting aside a certain amount of savings every month or every year, kind of defining what your contribution into the pot will be. Whatever it grows to, your kids get to use it for their college. The alternate to that would be to frame it in terms of the cost of college. We're willing to pay for 25% or a third, or we'll pay for half. Whatever it takes for you to get to the point that you can actually fulfill on that commitment, then you're going to do what it takes, right?
Yeah, that's what I was just thinking. We're talking about this being a free decision, a choice that you get to make, and we want you to sit down and talk to the right people about that. But what if you haven't prepared? Is the decision already made for you? If you haven't started early and you want to help your son or daughter with college, but you're not ready, I'm not sure there's much of a decision there. So I would invite your certified financial planner into that discussion. Talk to your spouse about what your intentions are, but then sit down with your certified financial planner. And if you don't have one, contact us. We'd love to help you and figure out what's practical and what the reality is. Hopefully, you get out in front of this thing and you're starting to save. So the next choice is, where do you save? Where do you save? Are there certain accounts that are better for saving up for college than others? We've got that and more coming up here on Wise Money with Korhorn Financial Group.
If you get a certain grade point and you work on your standardized test scores, that's one of the ways of funding college.
Well, one of the choices, hopefully we have time to get to it, is about the FAFSA, which is really not should you fill out the FAFSA. It's really what's your approach to financial aid, and that's why I wanted to throw that choice out there. So you can bring that up. That'd be great.
Because to me, if I'm going to talk about this next one, I would say there are four ways to pay for college.
Yeah, bring that up then.
Merit,
That's great.
Merit-based, investments, debt, and cash flow. Is it that simple?
Need-based?
Yeah, need-based would be the other one.
Financial, merit-based, and need-based. So, like I said, 1, 2, 3, 4, 5 ways to pay for college.
You got it. All right. And Daniel,
But we're only gonna hit
this choice is okay. So you're saving up.
investments.
Yeah.
So can we have a little speed round, and I just go through? Okay. The good, the bad, and the ugly. For investments, 401k,
Yeah.
IRA,
Yeah. You can take it
Roth
wherever you
IRA,
want, man. We've got.
ESA, 529, private 529, non-tax taxable account.
Take it wherever you want. We've got lots of space. Yeah.
Okay.
You
Well,
can go wherever you
I
want.
don't want to take the host job. You know what I'm saying? Well, actually, I do.
The host actually has laid out where we're going to go, but if you are free to wander. They're crafted in a way that we
prone to wander. Lord, I feel it.
and iRig is working and everything. That's all working good.
You rig.
I actually had to pull a little bit of, we were pegging for some reason.
Yeah.
on This, so I,
That thing is so finicky.
yeah, I knocked it down.
Let's get a new one. Different one.
All right, we ready?
That's what I propose. C-Dog?
Never have enough iRigs.
Should you fill out the FAFSA or not? What is your approach to finding aid or scholarship for college? That's a big choice that you have to make and your child has to make. We've got that coming up here. This is Wise Money with Korhorn Financial Group. My name is Mike Bernard with Kevin Korhorn and Josh Gregory coming to you from the KFG studios. Special thanks to the attorneys at Ledoux, Curran & Keene, as well as First State Bank for making the Wise Money Show possible. If you have questions, if you have needs, we want to be a resource to you. You can find us online, wisemoneyradio.com. You can reach out to us right there on the right, as well as catch up on previous episodes. Also, you can call or text 574-222-2000. This is tax season. I know a lot of you have tax questions. You might have needs with your taxes. Contact us, 574-222-2000. And one more time, all over social media, you can follow us, you can connect us with us, you can like us, YouTube, Facebook, Twitter, at Wise Money Radio. We are talking about the most important decisions you need to make in the area of college planning. And we've already hit the most important one, and that is, what role are you going to play? What role is the child going to play? Say you've made that decision and you're ready to start getting ready to follow through on that decision, and that is saving up. What's the right type of account to save up into?
Okay, so can we just play a quick game of the good, the bad, and the ugly? And I'll just give
There's
you...
three of us here. Let's do it.
I was gonna say, why were you looking at me for ugly?
Okay,
Man.
so here we go. You tell me 401k. Saving in my 401k for my kids' education. Good, bad, or ugly?
For college?
Yep.
Bad.
Why is that?
Because it's meant to be a retirement vehicle. It's difficult to get money back out of it after it's in there until after you reach retirement age, unless you're borrowing it back out.
Well, but yes, you can take a loan, but sometimes those are expensive, and you're missing out on any market movement and appreciation, and the payback on that's 5 years, blah, 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 blah. If you leave your job, it's considered a distribution. There's a whole bunch of reasons. The 401k is designed for a retirement, as a retirement plan.
Okay, we're going with ugly.
Thanks.
Okay, traditional IRA. I put pre-tax money in. It's growing tax deferred.
I'm calling it bad.
Yeah, I'd give the same answer. What's the difference between bad and ugly?
I don't know.
I've had people use their IRA for college, and it wouldn't be ideal because once again, that account is built for retirement. But if you use the money for college, am I right? That's one of the ways that you can pull money out and avoid the penalty. You'd have to pay
Not
tax.
tax,
You'd have to
right.
pay tax on it. That's why it's bad, not good. But you would avoid the penalty for college.
So in the situation where for some reason I'm in between jobs or I have a low income year and I've got a bunch of IRA money, I could pull up to 10,000 out.
Only if you're on track for your retirement goal and you're not robbing from that goal.
I like
right?
that, yes.
Okay.
Yep,
So that's bad.
yep,
So
yep.
first one ugly, that bad. I see where you're going.
Okay. Roth IRA.
I think in the right circumstances, this can be a good tool to use. If you haven't already earmarked those dollars for retirement, and as Mike was saying, you're not raiding the cookie jar to pay for college just because college came along first on the timeline of life.
And you said good, bad, or ugly. I'm going with meh. I think meh is between good and bad for the Roth.
So tell me about the accessibility of the Roth IRA.
Well, you can always get access to your contributions,
Okay.
right? If you have converted money from an IRA to a Roth, you've got a 5-year waiting period before you could get access to the money without any kind of penalties or tax on that. So, it is similar rules to the traditional IRA that we just covered, but the fact that you don't have to pay tax on your contributions coming back out can make it an okay place to get your hands on some money.
So the disadvantage to tapping into that is really
I'm saying the missed opportunity for long-term tax-deferred, tax-free growth on that money.
okay.
Okay, for sure. Because if you're using that to fund kids' college, most likely you still have another decade or two of working, let's say a decade, but then you still have another 3 to 4 decades of life. And that Roth IRA will continue to grow tax-deferred and tax-free. So any money you pull out of that Roth IRA, even if it's a little more convenient than the other two for college, you're robbing yourself of all of that retirement tax-free growth.
Yeah,
That's my point.
That to me is the ultimate risk here. You have a question when you're trying to decide, am I going to save for college for my kids? Is that standing between you and your own retirement? If you fund college, is it going to prevent you from being ready for your own retirement? And this is kind of the exact same question. If you pull money out of a retirement account and use it for college, have you bankrupted your own college or your own retirement and you don't even know it yet?
I mean, that is one of the choices, and we'll lay that out a little bit later, is do you use a retirement account or do you pull money from your retirement to pay for college if you're not ready for college? And so I would just say, no, you shouldn't.
Okay.
I agree.
Okay?
Obscure. This is a little obscure. The Coverdell ESA, the Educational Savings Account.
I'm calling that ugly. And the only reason is you're so stinking close to getting it right. You're so stinking close to being good. I'm just going to call it ugly. It doesn't have the tax benefits going in on the way in. It doesn't have some of the tax benefits of the good option, in my opinion. And so why use
But
it?
are you thinking of this as should you contribute to it? What if the money's already in there? Why would you not tap into it?
No, we're talking about contributing money
Oh,
into
I thought we were
it.
doing withdrawals here.
Well, and one of the
Okay, yeah. You're right, Josh. As always, if you already have money in there, or someone's been putting money in there, then I would call that good for college, or maybe meh.
Okay, one of the things that used to be unique about the Educational Savings Account was you could use it for K through 12 private education. And that's not unique anymore because the next one, the 529.
You mean the 529 college savings plan is not just for college anymore?
That's
How can you sort this stuff out?
That's right.
maybe the best news ever.
Well, right, but they've got they've got to have a rebranding marketing effort here for the 529 plan.
No, I think you hit it. It's not just for college anymore.
That is, yeah, there we go.
It's like it's an education savings account or something.
529 plan, good. It's good. It's like it's the Roth IRA for college, and you guys know the Roth gets a a disproportionate amount of attention because it doesn't necessarily benefit you on the way in, your contributions, although we'll come back to that. And it grows tax deferred and comes out tax free if used for college. That's an awesome deal. Now, the reason why the 529 plan can be even better is depending on which state you live in, what state taxes you pay, you can get a actual state tax benefit on making contributions. So wait a second. You can get a state tax benefit on your contributions and pull the money out tax-free. That's good. That's real good.
I'm calling that great. If you live in Indiana, that's great. If you live in Michigan, so in Indiana, you get a credit. One of the best 529 plans in the nation.
It's not one of the. I actually just, because I'm a geek, I looked at the whole list again recently. It's the best. It's the best.
Like I said.
We're not the best at a lot of things here in Indiana. Certainly not football. This year, maybe basketball. But the 529 plan, the college savings, we are the best. It's pride. I'm proud.
There we go.
Josh, you just recently
Kevin and I
moved
live
to
in Michigan, so
But you pay Indiana tax,
And
which is a good
that's why
point.
Kevin was
pay
hedging a little bit there.
Yes, we do pay Indiana tax, and we do get a benefit. So tell me about the private 529.
So the private 529 is actually, and I'm not going to get too technical here, but there's two parts in section 529 of the Internal Revenue Code.
And if you don't know about the other part, you need to be talking to your certified financial planner. If this is the first time you've heard of it, call 574-222-2000 and talk to a certified financial planner, because this could be a tool that you need on your tool belt.
So within that section of the Internal Revenue Code, the language says you can save up in a tax beneficial way for college, or you can buy credits today. I don't know exactly the term, is a prepaid college account, whatever they use there. But the private 529 is essentially a way of buying credits today. Instead of investing the money and saving it up, you're putting it into a separate account and you're buying credits today. You can do that with the states as well, but if you're doing it with the state, that means your child needs to go to a state school. With a private 529, it actually it's a more broad list of schools that you could go to. So another big question, though, decision that you need to make is, how do you approach scholarships? I teased that out there. We've got that coming up and more here on Wise Money with Korhorn Financial Group. That's kind of fun. You're in charge of all the
good,
outlines.
bad, ugly, and meh was the dominant answer.
Is it
there.
nice to be out of the hot seat for just a moment there, Mike?
Yeah. You might have found yourself a new responsibility here.
Yes.
So, we just snuck that one in there because of time. I don't know if there's anything additional we need to talk about there.
Well, I think to me there's two more.
Okay.
There's a taxable account.
Oh yeah.
And there's cash flow. Mm-hmm. Because you're getting to the point where you're maybe close to having a mortgage paid off, close to having a car, close to having something where you can make an adjustment and get some things done with cash flow.
Bonus content here for you on YouTube. There again, that's not going to be an option for you if you haven't been preparing.
That's
if
right.
you haven't been preparing all along.
Right.
Maybe
But some people have been accidentally preparing, not realizing, and they've only got $12,000 left on the mortgage, and they realize, hey, if I get rid of this, I just freed up $800 a month.
And maybe that's the right word, because a lot of people have accidentally not prepared.
Right.
They had full intentions of helping, and then all of a sudden they realize, nope.
And
that time
Or
is
worse, they have not prepared, but they help anyway, and they pay the price down the road when,
Yeah.
they can't bounce back from lack of time anymore.
so so cash flow is in restructuring, as in restructuring my cash flow. Cash flow is in dad goes back to work or mom goes back to work, whatever the situation is. We know those people, right? Mm-hmm. I used to be a teacher. I stopped, was doing this, and now the kids are about ready to go back to college. So I'm doing that. The last thing it feels like we need to hit, as long as we're talking about these investments, because I was thinking about this client who was in the Army ROTC at Notre Dame back in 1995. and he had IDS Growth Fund. That was a
Oh
mutual
yeah,
fund.
how to invest?
Well,
I was gonna bring that up.
because I told him at the beginning of the year, hey, guiding principle wise, you really should. This money is for your kids' education. It should be in cash. He didn't put it in cash. His 40,000 was worth 50 at the end of the year, versus his 40 being worth 40,200. Well, actually, that was back when money markets were paying 6%, so it would have been 42 grand. But this is the hard thing, especially right now with the if things are ruled by fear and greed. There's a froth right now, and everyone's saying, "Why would I put my college education fund in cash?"
We gotta
Did you
hit
see
that.
how much money it made last year?
Here's the deal: we're in the third segment, and we've got to have the last segment to talk about a couple tax questions, but we've got to hit that. So,
So
let's-
we'll speed round it.
we'll speed round it, and then I do want to go into what you had there for the 5 different ways you can pay for college.
Okay.
And we'll tee that up through that FAFSA question. Okay.
Yes, fa.
Thank you for being with us today. This is Wise Money with Korhorn Financial Group. My name's Mike, joined by Kevin Korhorn and Josh Gregory in the KFG studios. Thank you to Bethel College Adult and Graduate Studies, as well as Diane Bennett with the Remax 100 for making the Wise Money Show possible. If you need help, if you have questions, reach out to us, 574-222-2000. We tell you all the time, run, don't walk to your certified financial planner, and you need to. You've got to take action on this sort of stuff, especially with college. It's a very, very tricky goal. You need to save up for a long time, and then you spend it all in just a couple of years. Reach out to your certified financial planner to help you with that strategy. If you don't have one, give us a call. We would love to help. You can also find us online, wisemoneyradio.com, or all over social media at Wise Money Radio, as well as YouTube, Facebook, and all of that. So we are talking about the most important decisions you have to make in the area of college planning. And if you're saving up, if you've made a great choice in that first decision, and that is, well, you do want to help pay for some of your kids or grandkids' college, where do you take the money from? And Kevin led us through a fun game of the good, bad, the ugly, the meh, and the great. But there were a couple other options that we had there.
Yeah, so if you missed it, you want to listen to the podcast. In the last segment, we dealt with the 401k, the IRA, traditional IRA, the Roth IRA, the educational savings account, the ESA, the 529, the private 529, and now let's just talk about a taxable account.
So a taxable account, though, is one. It's just an investment account that has no special tax shelters or anything, and so it's just an individual or a joint account.
That's right. So the benefit of this type of an account is it's not tied to a certain part of the tax code that kind of dictates or sort of steers you towards a certain use. A taxable account really has maximum flexibility on what you use the money for. You could be piling money into a mutual fund for a down payment on a house. It could be the wedding fund someday.
Yep.
Maybe it's part of your retirement, but it can also be an account that you actually use for the college years. The nice thing about a joint account or an individual account like this is if you don't end up using all the money for college, you can repurpose it for something else very easily.
Yeah, in my situation, and I've recommended this to clients a lot, my folks saved up some to help, and yet we never had this intentional discussion. We never did. And yet I was just hardwired. I think from my upbringing, as soon as I got a car, I was working. And I so I could get to my job, I was working, and that didn't change in college, even though I had to do well in school and all of that. And so I just started paying for my own college. They paid for tuition, huge, huge blessing. But by sophomore year, I was paying for my own room and board, all my expenses, and it was a huge gift to me. Hey, at graduation, Mike, here's the money we had saved up for college. Good luck. And Cindy and I ended up using that as a down payment on our first house.
Nice.
Huge, huge blessing. But that speaks to that maximum flexibility. But limited, if not no, tax benefit.
That's right.
And the reason I would say limited is the growth would be capital gains, and current tax laws, capital gains are treated pretty favorably. But that could change.
So, okay, those are all of the investment options. So if I've got from a freshman in high school on, if I had a taxable account or a 529, or these other accounts that I have a choice in how they're invested. How should I invest them, have the money structured for this educational event that's approaching?
That's the secondary choice that you have to make. If you're saying, I'm going to help, that's decision number 1. 2, I'm going to put money in one of those accounts that we just mentioned. 3 is, how am I going to invest it? That's a big choice. Right now it's tough because you look around and everyone's making money. But the tricky thing about how long is your retirement going to last? Your retirement's going to last 30 years. So a lot of times we see people make the big mistake. You might have made this yourself, where you're on the heels of retirement and you put everything in cash. No, you've got 3 decades here. This money is still long term. With college, if your son or daughter is going to college for 3 decades, we have a problem. No,
I had a roommate like that,
They're
actually.
going for 4 years, maybe 5 years. So as soon, actually before they start college, your time horizon has gone from long to intermediate to short. And if you just follow prudent investment principles, not trying to time the market, then your risk should be reducing rapidly as you get close to your son or daughter being a freshman.
Absolutely. You've got to start dialing down the risk because you don't have the time to bounce back like you did when the kids were 3, 4, and 5.
Yeah.
Right? My kids are still young enough that I can be pretty aggressive with their college savings, but there's coming a day, and it's coming way faster. My oldest just turned 10, freaking me out, actually. Double digits now. We're getting closer and closer to the point where I'm going to need to start dialing back the amount of risk that we're taking, which means those investments aren't going to be growing as quickly and carrying as much of the weight. That's why I have to stay disciplined in feeding the accounts regularly. Or another strategy that we've talked about is, are there things that you can do to put yourself in a financial position that you just have more cash flow available when they get to the college years?
Yeah.
Right?
That's where that could be a way for you to take a little bit more risk. And then if the market's down and you can keep your composure, you can say, no, I'm going to fund this year out of cash flow and let the investments recover a bit.
Yeah, it's really tricky because Indiana 529 came out with the credit, I believe, in 2007.
Yep.
And so we had clients that put money, $5,000 in to get a $1,000 credit. So they did that in 97, and then they did that in 98.
You mean
2007.
07, 08?
Yes, as I was saying. And so 07 and 08, well, by 09, the $10,000 that they'd put in had grown to around $6,000.
Yeah.
And I remember having this conversation a number of times, people sitting down and saying, oh, the 529 is just a bad plan, right? No, it's not a bad plan. It's actually a great plan. The investments have been, squished down, if you will, because of what the market's done. And they say, so what should we do? What should we do? Thinking along the lines of, well, we should probably get our money out of that and put it in something else. And my answer across the board was, give me another $5,000.
That's right.
There again, this is why you need a certified financial planner, because that would be my natural instinct as well, Kevin. Well, this was a mistake. Let's take it out. We'll try something different. And your certified financial planner is going to help you frame that, as well as then coach you on the prudent approach to take. Run, don't walk to your certified financial planner. Reach out to us if you need help, 574-222-2000. So, all right. Josh touched on something there that I want to float back to the next choice, and that is, in the spirit of how are you going to pay for college, one avenue is financial aid. So a choice, actually, I've heard this more and more recently, is, do I need to fill out this FAFSA? But it's actually a bigger choice than that. And it's really, what's your approach going to be towards financial aid? And we don't have a ton of time to fully cover this the way that I think we need to. But Kevin, run through the few ways, just a handful of ways that you can pay for college.
So I come up with 5, Mike. There's need-based financial aid. There's merit-based financial aid, which a lot of times the colleges do. And this is where you want to get started early. There, you can use your investments. You can use debt as a tool, or you can use cash flow.
One of the confusing things, and I would argue maybe the most confusing, probably a little more confusing than even saying the word FAFSA, is the FAFSA. And college financial aid disguises debt and scholarships. Those merit-based and need-based, it's disguised with debt.
Yeah.
And so it's really hard to ascertain, okay, am I going to have to pay this back? Is this a good thing? Should I do this or not?
Yeah, I think the point in all this is the FAFSA is the starting point for you to get any of those first three options on paying for college at your disposal. Many colleges require that you fill out this federal form in order to get even merit-based aid. It has nothing to do with your financial picture, but that's where they get all their data when they're making their decisions. Certainly the need-based aid, such as student loans or scholarships or grants, you have to fill out the FAFSA for that.
Yep.
And unfortunately, it's always been mind-boggling to me, but even a student loan is considered financial aid. And if you want to be able to tap into some inexpensive debt or even forgivable debt, you have to fill out the FAFSA.
We've got a couple of great tax questions coming up. One from Tony that he got some bad news after buying his health insurance through the exchange on what his taxes look like. He's looking for some help. We've got that and more coming up here on Wise Money with Korhorn Financial Group. Okay, we're coming back to that. That is so good.
Okay, so I
That's
missed.
so good.
I missed one.
Oh, did you?
Yeah.
You only said 4?
No, I said 5. There's 6.
Oh, there's 6.
Yeah.
What's the 6th?
Grandma and
Get the
grandpa.
grandparents to pay. That's right.
That's close. Someone else paying. Who?
So you're talking, aid from joining the service or government or
Well, I wasn't, but that would you could add that one.
Your
would that
employer.
be that fall under merit based? Oh, employer benefits.
We just set up an educational plan for a client who has a small business.
Cool.
With this person has a very profitable small business, sole proprietorship. Just her. Actually, it's not a corporation. Just this person, and only 2 employees, who are both daughters.
Okay, so I would argue though that is still the client paying for it, just out of their left pocket instead of their right.
However,
And
hang on. So we have
It's
if they're the business owner, I mean.
it's deductible.
we have
Right.
a lot of listeners who own a small business, and this is bonus content in between segments here on YouTube. But if that's you, this again, your certified financial planner should be bringing confidence and clarity, but also creativity. So I'm going to say you're both right, but the creativity on that to get it done in the most tax efficient way.
Yeah.
Josh is saying it's still her or his money.
She's still sacrificing her own dollars, just running it
Right,
through a
well,
more
Josh, you
tax
just took
sensitive
all
way.
the fun out of it again.
It's my job.
You're right. No, you're partially right.
I'm trying to make you right, and the number really is 5.
Can we pick back up this FAFSA? What else needs to be said there about paying for college or about that choice?
I would say if you're listening right now and you haven't already done your FAFSA,
FAFSA.
get it done.
This is
DUN done.
Yeah,
it'd be late.
we're like 6 months
Right.
into the season already, so
I
Well,
know
we
get
can
on
remind
it.
people
I
of
know,
those,
dude.
of
Listen,
those timelines.
listen. I can promise you, there's someone listening who has intended to do it October 1st,
Yeah.
and has yet to do it.
You're right.
And so, a gentle encouragement, loving, prodding,
Yeah.
chastising.
All right.
Shaming.
Fourth segment. We're landing the plane. All right.
And the question you teased out was from
Tony.
Tony.
I think we're going to be able to get to both of them.
What you talking about, Tony?
Did anyone research that second question?
No, I didn't even look at these questions. Oops.
Well, the answer is always yes. Becky, it's your first offer.
We might not be getting to that actually, but the hope would be. I don't have it right in front of me though. So
So basically, the question is: does a substitute teacher get the same tax benefit as a full-time teacher?
900 hours is what's coming to mind. 900 hours as a teacher, counselor, principal. 900 hours.
It's pretty
So.
specific.
All right, we ready? All right, if you had your health insurance through the exchange and you got a nasty gram when you filled out your taxes. What do you do? Sadly, that's a reality for a lot of folks, a lot of you out there, and we've been able to help a lot. So that's Tony's question. We've got that coming up. This is Wise Money with Korhorn Financial Group. My name's Mike Bernard, across from Kevin Korhorn. Between us, Josh Gregory, coming to you from the KFG studios. If you've missed anything, you can catch up on the previous episodes in several ways. I'd first direct you to the YouTube channel. That's my favorite way to watch the episodes. And you can hit that like button down there if you like the content, and even that bell, which subscribes you to the show and get all the updates.
And if you can't understand us, which is quite possible, on the YouTube channel, you can read the words.
Yeah, yep. Or you can just quickly rewind and so on. So right there, just search at Wise Money Radio on YouTube. You can also find us on podcast. Every episode is on podcast form, iTunes, Google Play, Wise Money with Korhorn Financial Group. We are going to find a way to shorten that up, but you've got to type all of that in. That's Korhorn with a K, and then you'll find us right there. And lastly, wisemoneyradio.com online. Every episode is right there online as well, and you can submit questions. If you need help, if you have questions, 574-222-2000. Call or text 574-222-2000.
Is it worth noting? I mean, you've invited people to call our office if they, have tax questions. We're right in the heart of tax season, but there are a lot of folks every single year who come into our office and they actually haven't filed their taxes for 2 or 3 years.
That's right.
Maybe they have kind of a messy situation, and it can be overwhelming to file your taxes. And we actually, this is further evidence that we are an office full of nerds. We actually enjoy getting in and helping you sort out that mess. It is not too late here to seek out a professional and even be doing some careful planning. There's still some time to affect last year's tax return, as long as you don't wait until April 17th.
That's a great segue into Tony's question, but we've got to wrap up the conversation on planning the most important decisions you have to make in the area of college planning. And one of them is, how are you going to pay for college, or what's your approach going to be towards financial aid? Kevin laid out 5 different ways that you can pay for college, and the first 3 really deal with, you need to get your FAFSA done, free application for federal student aid. You've got to get that done. It opens October 1st. Depending on what state you're in, that application closed March 1st or March 10. So we're just past that deadline. But it's going to open again for next year, October 1st. And if you didn't fill out your FAFSA in time for this next school year, I'd call the school. Call the school and say, is there still a way that I can submit my information? A lot of times people look at their income, their situation, and they say, well, I'm not going to qualify for anything. You'd be surprised how many times you'll qualify for something at the school level as opposed to the federal level, but they're going to use the information on the FAFSA. So fill that out. I would mention one other thing before we get to Tony's question. If you've got a student who's in high school right now and looking at college, and you're exploring how are we going to pay for it, make it their job to fill out 3 scholarship applications a week. That's their job. I frame that as, you have to do this. Fill out those scholarship applications. Thanks to the internet web, you can find scholarships all over the place. Have them contact student aid department at their school. That needs to be a focus. That needs to be a job of theirs. 500 here, 1,000 here. That adds up.
That's right. That is maybe more productive than what they'd even be able to accumulate in summertime work. Right?
Possibly.
So take that seriously. You're right. 500 here, 1,000 there. It does add up.
And you're still getting a summer job.
That's
right. That's right. It's
right.
not an either or, right?
Oh, this is such a great question. Tony's from Mishawaka. We're transitioning to tax questions here. Here's what he said. My wife and I used the exchange to get our health insurance, a.k.a. Obamacare, a.k.a. Affordable Care Act, a.k.a. I'll keep going. But my tax preparer is now telling me that I owe a lot of money on my taxes because I made too much money. What is going on? And is there anything that I can do now? Let's just explain the issue first. The whole, one of the backwards things, in my opinion, with this whole Affordable Care Act is the way that Congress was able to push through a reduction in the amount of premium that you pay is by giving you a tax credit. Mm-hmm. Now, that's confusing because tax credits usually come on your taxes, but the way they position this one is we'll give you a tax credit in advance, and it'll reduce what you're paying on your health insurance. See how convoluted this is. And that's with the obligation or promise that you won't make more than a certain amount. People change jobs all the time. You might have been in between jobs or underemployed and said, I need health insurance because I'm underemployed and I'm not making much, so here it is. But you're pursuing getting more income in full-time employment, and then all of a sudden, God opens the door and you've got a new job making more money, and you get to the end of the year and you realize, I owe several thousands of dollars because I made more than what I thought.
That's right. It's almost like the government is lending you future credits that they think you might qualify for when you get to tax time. But how do you know for sure that you're going to qualify for it? Because you won't know 100% that you're going to earn a certain dollar amount until the year is up for most people.
It's a loan against your tax refund. It's a loan in advance against your tax refund, which we would say is always a bad idea. But this one can be resolved with some careful planning. But Kevin, I took the words out.
Yeah, I mean, Tony has entered the land of nasty surprises. Yeah. Because most people don't know going into it that if as I'm applying, I say my income's going to be X. If it's X plus, the credit that I was getting all along is they're going to ask for it back. Mm-hmm. And so, Tony, that's the situation that you're in. And it's a great question. Well, is there anything I can do about it?
Yeah, and just before we go there, one of the other nasty things about this land of nastiness is a lot of tax benefits that you get, the more money you make, they phase out. And some phase out pretty quickly, but it's kind of a gradual, well, you used to get this, and now you're getting a little less, and a little less, a little less. Okay, then it's gone. This one, a lot of it's just all or nothing, where a $1,000 swing, and truthfully, a $1 swing can mean a $13,000 difference on your taxes and tax due. All right, so what can you do? This the income amount that you promised to keep your income below there's several different income numbers on your tax return. This is confusing. The one that you're referring to is what's called modified adjusted gross income. Let's just stick to adjusted gross income for the sake of our discussion. It's the number at the bottom of your first page or at the very top of the second page of your tax return. So really your question is, what can I still do right now to reduce that number at the bottom of the first page of my tax return? Thankfully, there are a few options you might have.
That's right. One of the things that financial advisors are often using as a tool to impact last year's tax return would be things like a traditional IRA contribution. Mm-hmm. This is something that gives you a deduction. It helps reduce your income on the tax return, and it actually helps squeeze down that number that you were referring to, Mike, that is calculating how much of those premium tax credits are you going to have to pay back, or how many do you get to keep. Yep. And so the nice thing about a traditional IRA contribution is that you can make that contribution right up until your tax filing deadline, which is April 17th this year. Mm-hmm. Normally we think April 15th, but because of holidays and weekends and everything, it's a couple extra days. But the point is, here we are, we're well into 2018, and you still can affect last year's tax return by contributing to a retirement account.
They have these deductions on the front page of your tax returns called above-the-line deductions. The traditional IRA, which is often overshadowed by the Roth, it is a great choice in this at this time. Another option is health savings account contributions. That's also up there. If you were self-employed at all during the middle of the year, you could write off possibly some of your health insurance premiums there, self-employed health insurance deduction. If you were self-employed, make sure if you're paying self-employment tax, you can deduct some of that there. So there's a few options.
There's bigger retirement contributions you can make if you were self-employed.
That's exactly right. That's exactly right. So there again, once again, sit down with your certified financial planner. Get proactive so you avoid these surprises to begin with, but sit down and explore what options you still have. We are out of time for today. Thank you so much for joining us here for Wise Money with Korhorn Financial Group. On behalf of Kevin Korhorn, Josh Gregory, and all of us at KFG, my name is Mike Bernard. We'll see you next week for Wise Money with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management LLC. Doing business as Korhorn Financial Group. KFG Wealth Management LLC and Silver Oak Securities Incorporated companies are unaffiliated.